Welcome everybody here to our next webinar here at JFD Brokers. My name is Stefan Friedrichowski. Unusual time for me to have this kind of webinar, but a warm welcome to everybody out there. I hope that everything works well, that you can hear me, that everything works, and that you get the video exactly as you want to have it. Today's topic, profitable trading setups. That is a topic of today, and I want to present you two trading setups. But before we really start, let's have a look here on what we do today. And before we really start, just to show the risk disclaimer as always, because we talk about trading strategies. And whenever you talk about trading strategies, you have to keep in mind that finally, if you trade, you definitely trade on your own, as always. But I think you know that, and therefore I can skip this slide. Before I really start, just that you know a little bit about me. My name, Stefan Friedrichowski, and just in case you want to get in touch with me, you see my email address here as well. No problem, just send me an email, call me Stefan. My background about trading is a little bit untypical because education-wise I'm a physician. I have studied physics and did my PhD quite a time ago, so I'm 51 years old. And now since more than 6 years I'm a full-time trader. And my approach is maybe a little bit different from other people's approaches, because what I do is I do everything more statistically driven, more mathematically. So I derive my trading strategies purely mathematically. And that is the kind of trading style I do. And I can give you a little bit of insight of what I'm really doing exactly here today. So, in detail, the topics of today, they are, first of all, that I want to mention, hey, why is that important to have a probability advantage in your trading activities? And if you don't have those, then you should not trade. Just to see a little bit about that before we really come to our trading setups. Therefore, I have to mention for every trading setup, we need requirements, and those requirements should be really written down so that we finally can convert our trading strategy into a real trading setup. And then I come with two examples, and the two examples I want to show you. They are DAX daily seasonal, and the other one is open range breakout. Just got a message that that my microphone is not online, but it should be. Maybe you unfortunately don't hear me, but you have to switch on the loudspeaker directly in the YouTube channel. But let me check that first here, whether everything works well. So if I look here to my input screen, then I see that everything should work, but I'm not sure. Maybe I have to do something else here. Just let me try to enhance everything here. Maybe then we get it a little bit better. So let me see what I can do here. Video. Maybe I have to reduce okay, I cannot switch it right now. Good, because I'm online. So hopefully microphone works well. Let's see whether it really comes later that you get my voice as well, but simply let's wait for that. And maybe I can write a little text here. You have to switch on loudspeaker in YouTube. Good. So because I got that message indirectly on another channel. So let's see. I hope still everything works. So we go for 2 training setups, DAX daily seasonal and open range breakout. And as I always tell in webinars, what for me is quite important, and you should keep that question in mind whenever you listen to somebody talking about trading strategies, that show me your live track record, then I can believe what you're doing. And therefore, that is a standard sentence you should always ask anybody who talks about trading. Definitely I will do it. So I will share my track records here directly with you. Okay. So when it comes to trading, it's always important to have an edge within your trades. If you don't have an edge, then you should definitely don't trade. That sentence sounds extremely simple, but look maybe to your own trading activities. Sometimes you say, okay, I go long in euro, US dollar, but have you really a clear picture of why you are doing exactly that trade? So do you know that statistically that trade has an edge, so that you are more on the winner side than on the loser side? So that's always something you have to ask yourself when it comes to trading. The sum of your profits has to be higher than the sum of your losses. And only if you have an approach which has that simple basics, you should follow the approach, and that you can use it for your own trading activities. Doing that, we have to keep in mind that we don't forget that with all trading activities there are costs involved. And costs involved means simply that we talk about spreads, we talk about commissions, we talk about swaps. Definitely JFD Brokers is offering fantastic trading conditions for you, but we have to really involve those costs in our trading approaches. Because sometimes you see people showing you results, but they have not been really derived within including those costs. So you might see a good track record in an Excel sheet or back test in an MT4, for example, showing good results. But you have always to ask, is that guy really including spreads, commissions and swaps? And only if you do that, you get the real results for that trading approach. Finally, that means at the moment you open a trade, you are instantly in the minus. Once again, that's a simple sentence, but we have to keep in mind that at the moment we open a trade, we are first on the loser side. Only later maybe the trade is going to a winner trade, but those costs have to be recovered always and always first. Conclusion here: if we don't have an edge, if we don't have that kind of probability advantage, we should not trade, and we should be sure that we have that edge, and then we can start trading live as well. Good. But how can we develop trading strategies? And those trading strategies I will show you in a minute are exactly being developed how I point out here. First of all, everything starts with an observation in the chart. So that is something that is my source of trading strategies, the main source. Some basic thoughts about trading or price movements, they are involved from time to time, but 90% is done purely by observations in the chart. So what do I mean? Of course, still I'm looking to charts and see, okay, maybe I have an observation like if there are 3 green candles in a row, then the fourth candle should be in advantage, the red candle. Maybe don't take those words now serious, but maybe that is a kind of observation. If you have 3 candles in a row green, then there's a probability advantage that the next one will be red. Definitely not every fourth candle will now be a red candle, but that is something which is only statistically. So I got a message here that somebody has an echo. I'm not sure why that happens. That's really a pity, but I cannot change the settings here. And I'm sure that I'm, once again, I have a look here, that I'm really, maybe I can go down here a little bit, so hopefully that will become better now, so we don't have an echo anymore. Let's see. So the next thing, after we have made such kind of observation of our trading idea, we have to prove that approach. Still somebody's telling me there's an echo. Okay. But definitely I have only one microphone and no external speaker. So hopefully it gets better during I speak here. So after we have proven that we have such a statistical edge and that we have really to do via, for example, Excel, other analysis, then we have to really create fixed rules for our trading idea. Just saying, okay, 3 candles in a row are green, then open short rate is not enough. So we need a clear idea of where to set stop loss, a clear idea of what is the real entry criteria. 3 green candles might be enough as an entry criteria, but we need, for example, a stop loss. And what we need else is we need an exit criteria for our trade as well. So when should that trade come to an end? And maybe there are 2 possibilities. We get a new signal, or we reach our stop loss, or we might reach our take profit. But all in common is that we need an exit. You see already that my must rules for the must rules for creating a trading setup that take profit does not belong really to the must rules, but as long as we have an exit criteria, it's okay. So therefore, we need definitely a stop loss, not necessarily a take profit, but of course we need an exit criteria. The stop loss is important because of 2 things. One, every trade needs a stop loss. And the other is, otherwise we cannot calculate correctly our position size for the trade. Because we want to have a certain risk for every trade, and we know where to place our stop loss, and only then we can calculate the right position size. I got a question here about the video. The webinar is recorded. You will find the webinar later on the JFD YouTube channel. So if we have gone through the complete list here, then we have a trading setup which is well defined, and then it's easy for us to follow our own trading setup. And of course, the two trading setups I will present later, they exactly follow that methodology here. Good. The first trading setup I want to show and to share with you is the DAX daily seasonal. But before coming to the real setup, just let's talk a little bit about seasonals in general. You see already here a picture of what I called the mother of all seasonals, and that's simply climate. Of course, what you see here is the temperature development during the year for the town where I live, and something like that is creating us an edge. That's the reason why I present that picture here, because in this case everything is quite easy and quite simple, but we use the same kind of approach later for trading. The reason why I'm mentioning that one here is, if I ask you the question, what kind of temperature should I expect in July, then of course you have an answer. And you will not tell me my temperature prediction for July is -10 degrees. Why? Because we have something which reoccurs every year, and that is a typical temperature curve over the year. Sounds simple, but that is the reason to use seasonals, because what we try to do is to find reoccurring events which give us a bias for our decisions. So if your task is to give a temperature prediction for July, then of course you use that curve as a bias. And if you have something similar for trading, that we have a bias for long, bias for short trade, then we can talk about seasonals for trading. There's another seasonal which is, I think, the well-known, most well-known trading seasonals ever, and it's the Dow Jones Index cycle, and that is the 4-year election cycle in the United States. So what someone has done here is he has looked for the last nearly 100 years for the behavior of the Dow Jones, and what he found out was that every 4 years within the United States they have election, and therefore he divided the chart in 4 periods: the election year, post-election year, midterm and pre-election year. And then he normalized the typical change of the Dow Jones during those 4 years. And what you can clearly see is the midterm year is a year with more or less no change. The pre-election year, for the first half of the year, you see a straight move to the north. And you can see similar things in the post-election year here. So we can use that kind of information as a bias for our trading activities. The problem with that kind of seasonals is always that they have more or less pure statistics. In this case, it's not that bad because it's 100 years, but nevertheless 100 years are only 25 election cycles, and having something with a statistic of 25 is not that huge. You see already, if for example I would present on my next slide a seasonal of the DAX over the year and saying, oh, I got a message, very good, that the problem with the sound seems to be solved. That's very good. Thank you for that notice here. But back to the story. So if we, for example, would plot the DAX over the months, of course we can create a typical chart. But looking, for example, for 20 years back means we have 20 data points for January, 20 data points for February. That's a pure statistic. And on the other hand, especially if we talk about indices, we have overall trends. So that during the last 100 years the Dow Jones went up, it's not a secret. And so we have those points as well. So that's a problem. But we go a different way here for our DAX daily seasonal. So what we try to find is, once again, a pattern, a typical behavior, as the methodology of DAX, of seasonals in general. And before I really come to the setup, other events might be months, days of weeks, hours, and whatever. The main assumption always is that everything repeats, which is good. That's a good assumption, and that's something we have in mind always when we talk about trading. Our question here is a little bit different. We ask about day of week, and that means we try to find a correlation of a specific day of the week, like Monday, Tuesday, Wednesday, and so on, with a certain move, maybe north, which would offer us a long opportunity, or maybe short. So is there maybe some a specific bias? So and the answer is yes. But you will see, and I will switch now to Excel, so that you see clearly what I'm doing here. And what I do here is I have started with DAX prices. In this case, to be more specific, it's the so-called FDAX, the future for the DAX. And I started with data from 1999. And I asked myself, first was, do we have days with very high volatility? And you can clearly see within that graph here, there's maybe Thursday is the one with the highest volatility, but the changes are not that huge. But then I asked me a different question. What if I apply one additional rule, and that is simply that I introduced an EMA to tell me whether we are in a bull market or whether we are in a bear market. And so I took an EMA. You will later see that EMA is 40. And if the price is above the EMA, I say, okay, that's a bull market. And if the price is below that EMA, I say, okay, that's a bear market. Okay, clear, easy definition. And now I ask, what is the average change within that day? And astonishing, it's a little bit more tricky. If we are in a bull market and we have a Monday, yes, that is a day to go really long. On Tuesday, within a bull market, the average price change during the day, and when I say during the day, I mean between 8 and 10 o'clock in the evening, is to the south. So on Tuesdays, in a bull market, in average, statistically, the price goes down. On Wednesday, more or less no change. Thursday and Friday are, let's say, normal bull days. Normal bull days would mean, hey, a long position is the right decision. And we can do the same analysis for the bear days. Monday, more or less okay, slightly negative, but on Tuesday, even if we are in a bear market, we should open a long trade. So it's exactly same opposite sign like in bull markets. And on Wednesdays, we should go long as well. Thursday, different. Thursday is a short day in a bear market, Friday as well. And you see, it's a clear picture now here. If we are in a bull market on Mondays, Thursdays and Fridays, we should do what we expect to do, open long trades. And on Tuesday and Wednesday, we should open short trades in a bull market. So, and the definition of bull and bear market is here simply, are we above EMA or below EMA? And that's all. So it's a purely statistically driven strategy. And what we can do now is we can calculate those trades so that we finally get something like an equity. And that equity is shown here. Let me scroll down a little bit so that we have everything here within the screen. I do it a little bit smaller because I still want to have the EMA filter. So you see the equity. The equity is in risk unit R. So every trade, if finally is a loser trade, then we would have a result of -1. And the trading logic here is open the trade and open of market. We set a stop loss, and if the stop loss is not reached until 10 p.m., then we close the trade. That's all. Within that Excel sheet, and by the way, if you want to have that Excel sheet, just send me an email and I make sure that you will get that Excel sheet. Yeah, it's we can now change the parameters like EMA value or the stop loss value for our trading. So for example, if I change the EMA to 45, of course the equity will change now. My computer is unfortunately a little bit overloaded here by compressing the data for the video, but therefore it takes a little bit time here. But now you see, okay, different equity curve. It looks a little bit more straight, but the beginning is not that straight. So what we can do here is we can try to figure out the best parameters for the trading setup, and we have only 2 parameters here. One is the EMA period, and the other one is the stop loss distance in percent of the price. So that's the complete set of rules for that strategy. And we don't need anything else. What we now have is a proven statistical edge, and that means we can trade it. So to summarize that kind of trading setup here, what we do in order to open or decide about our trades. In the morning at 8 a.m. we compare the EMA value, and the EMA is with a period of 40 with the previous of the previous day. So the EMA of the previous day, we compare the open of the day with the EMA of the previous day, and now we know whether we are in a bull market or whether we are in a bear market. And in most, for most days, you know that already before 8 o'clock, because you can see those pre-indications of the DAX. So it's not a surprise what we have to do at 8 o'clock. And now the definition is clear. We look what day of the week we have, and in a bull market, yeah, on Mondays, Thursdays and Fridays we open a long trade. On the other 2 days we open a short trade. In a bear market, so if our price is below the EMA, then we do exactly the opposite. That's all. So that's the complete setup for that trading setup. We open the trade, we place our stop loss 1.1% away from our open of the trade. So we have a stop loss, which is good. And now we have nothing to do until 10 p.m. And if stop loss is not reached, so the trade is still open, then we close the trade before we go overnight, because we don't want to have any position overnight. So that's all. That's a complete setup of that kind of strategy. And as I mentioned, I don't want to just show you the trading setup. Let me show you real results as well. So I trade that strategy here since a couple of months now. So we have at least a little bit of statistics for that live track record as well. Let me first look here to the chart of what's today. So you see the red line, that's the EMA. The open was far above the red line. Then what day of week we have? Okay, today is Tuesday. Tuesday is a reversal day. That means we are in a bull market. On Tuesdays we open short trade. And you see exactly that's what's here. There's a short trade running. Stop loss is set 1.1% away from our entry. And all we have to do is to wait for 10 o'clock. If the stop loss is not reached, then we close the trade anyhow. And now we can look to our history of that account. And let me create a live track record here. So that I can really show you real trading results with that strategy. And I have to say there are only few people doing something like what I do now here to share live track records of trading accounts. But I think that is exactly what we have to do if we talk about trading, and especially in webinars when we talk about trading setups. So it will take a few seconds here until the screen pops up with the real track record here. And then let's look for the equity, which is now traded since, I think, since April, but we will see here. No, not April, it's traded since the 1st of June. So we started that account with 2,000 euro, and you see here the list of trades being done within that account. And now I scroll down, that we get a picture of that equity, and that's the result. A couple of you may now say, well, does not look that good. I mean, above 5%, about 5% plus within 6 months or 5 months. Is that good? Is that bad? Honestly, that's good. So what I expect for that strategy to have after 12 months around 10% profit. And yeah, that is absolutely still a reach that we can have that. And the other thing, when I look for equity curves like here, is that I definitely look here for the maximum drawdown up to now, that is 3.6%. Profit is a little bit, it's about 5% right now. So we are still, we have gained more profits than we ever have lost as a drawdown. So that's another way of talking about risk-reward ratio. But that is a little bit above 1. And it's positive, definitely, because we have a profitable strategy. So is that result good or bad? I think it's good. And even you see live what really happens. Of course we have drawdowns, no question. We have been already near or close to 10% profit and went down now. But strategy works, strategy is simple, and all we have to do is open the trade at 8, close the trade at 10. That's all we have to do. So that's one strategy, and it's very easy to apply those rules for that strategy. I promised to share with you a second strategy, and the second strategy is about breakouts. And breakouts are open range breakouts. We can define more general first, but then we do it practically for a specific underline and with specific settings. So a breakout strategy is always something, there's a range, but now we have to define what range we are talking. And the range may be the price change of the previous day. That might be a certain range. Or the price change within last week. That is a range. We may even go down the road of time periods, and that we have a specific time within the day between 6 o'clock and 10 o'clock. That is something we will use later. And between those 2 point in times, we ask where's the high, where's the low within that time range, and that creates the real range. You may use pivot points, whatever. So there are a lot of other examples as well. In general, you place 2 orders. One order, a buy-stop order, is placed at the upper level of that range, and another order is placed at the lower level of that range. That's the sell-stop order. In most cases, if you talk about breakout strategies, you use the methodology of OCO, and that means one order cancels the other. Practically, that means if, for example, the buy stop is activated, you remove the sell stop order. In most cases, and in my case as well, the stop loss for that kind of strategy is always the opposite side of the range. Let's do it visually, because then it becomes even more obvious what I'm talking about. But the basic assumption, to mention that first, of that kind of strategy is simply, if there's a breakout of that range, then that breakout should be long-lasting. So it should go further, and that's the basic idea. Within that picture, you can clearly see what I'm talking about. Here's an example of an old chart of Euro, Japanese yen, and that is, by the way, the underlying. I will talk in detail about the setup. And in this case here, and that's not the final setting, you get the numbers in a minute, you see 2 vertical lines, one at midnight and one at 8 o'clock. So first we have those 2 vertical lines here, and then we ask where's the maximum, the highest point within that time period, and the lowest. Unfortunately, the lowest is exactly at the end of the range here. Therefore, you can't see the candle exactly, but you can believe me, it's exactly here. So now it comes to 8 o'clock. At 8 o'clock, when the range end time is reached, then we place 2 orders. The buy stop here and the sell stop here. And for the next couple of minutes, we do nothing. We wait until one of those 2 trades, pending orders, is activated, in my case, the short side, and then we delete the long trade, and hopefully the price goes exactly in our direction. And as always, when somebody is talking about a trading strategy, the picture underlines exactly what he means. So therefore, price went down, and we have reached our take profit level, which is the green line here, and trade is profitable. But where to set the take profit level? In my case, in this visual case, I use the risk-reward ratio of exactly 1, which means the complete distance of the range has been added to the lower level and defines the take profit of the trade. What you can see here is that that kind of strategy has 3 parameters, or more mathematically spoken, those are degrees of freedom. And those are the range start time. In my example here, it's midnight. That's 1 parameter. Range end time, in my case, 8 o'clock. That's the second. And then the take profit multiplier, or better to say, the risk reward ratio for setting the take profit. But now the question is, what are the best parameter settings for trading that kind of breakout strategy? What I do here personally is I go more or less brute force. So I go for 10 years history, and I try everything. 6 o'clock, until 8 o'clock, 6 until 10, 6 until 12, whatever. So there are a huge number of combinations, and I try to find the best settings for that kind of strategy for a specific underlying. What you have to do if you follow, if you go down that road, that you have to avoid what is called overfitting, what's something I definitely do, but time is too short to explain how I do it now, but you will get the setting anyhow. So, but that's how I do it. If we talk in general about breakout strategies, there might be some additional options or, once again, degrees of freedom. And one good thing for breakout strategies is to apply an EMA as an overall trend filter. And the strategy about euro, Japanese yen will have exactly that additional option. To use an EMA as a trend filter. What does it mean? If we have an EMA within the chart, we simply ask, are we below or above the EMA? Same question then for the DAX daily seasonal. And we only place the order in the direction of the EMA, which means if our price is above the EMA, then we only place the long order. And if we are below the EMA, then we only place the sell stop order. Other options, just to mention that, we may apply something like a maximum range size. So if the range is too big, don't place a trade. Maybe we compare that value with previous day or whatever you have in mind. Maybe we use a minimum range size as well, and that's where underlines you definitely need something like that, because if the range is too small, and you always know we have to pay the spread, so if the range is too small, a little bit wiggling around of the price means reaching the stop loss. So a minimum range size additionally avoids trades if the overall volatility is low. So for example, between Christmas and Happy New Year or something like that, then the strategy would not trade anymore. Maybe you have other filters, even gut feeling might be an additional filter for that kind of strategy, but that's something we have to keep in mind, that when we talk about breakout strategies in general, we might use additional filters beside times like range start, range end, and take profit multiplier. So the strategy I want to share with you here is the open range strategy for euro, Japanese yen. And in this case, we have our parameters the following. The range start time is at 3 AM. And if I talk here about times, it's always German time. So range start time is at 3 AM. Range end time, and I wrote down here 9:59 simply that nobody, if I would write down 10 o'clock, that's what I really mean here, then you have to ask yourself, oh, do I have to wait until the end of that 10 o'clock candle or whatever? Therefore, I write down here 9:59. So at 10 o'clock, the range, that's the range end time. And between those two times, we look for the maximum, we look for the minimum, and we place our orders. But we only place into the direction of an EMA of 11. That's more or less smaller EMA value, so it's not a long-term trend behavior. It's a little bit more short-term active, and we use a risk-reward ratio of 1.7. As in the previous strategy, we use a time stop. That means if the trade is triggered, the trade is running, and the stop loss is not reached until neither stop loss nor take profit is reached until 10 PM, we close the trade. Why? Two things. One is I don't want to have overnight trades in general. I don't want to have swap costs involved, and especially I don't want to have trades over the weekend. So Normal nights would be okay because I don't have gaps, but over weekend I may suffer gaps as well, even for Forex trading, and therefore I close those trades. So a lot of reasons to have no overnight trade here. So what are the points of action here? 10 o'clock, calculating the range, placing the two orders, or the one order into the direction of EMA, better to say, and then wait until 10 and close the trade. That's all. If the trade is triggered, which is more or less in most cases, for most days, those trades are triggered, and we have one trade per day. As I mentioned before, I talk about trading strategies. Show me a track record. Show me what you have results for that kind of strategy. So we need a different virtual private server here for that strategy. It runs on this one here. And unfortunately, I cannot show you an open trade for today. You see the chart here, Euro, Japanese yen, but you see no trade is open. And the reason is the trade of today has reached already stop loss. Okay, but nevertheless, we see here that small error that was the open of the trade. It was to the north side. And you see what happened. Trade went down and has reached a stop loss. I think it was exactly here. So for today, I have a minus trade. Yeah, okay. But as every trading strategy, there is no guarantee for constant sequences of winners. But let's look for the track record of the account. So I do the same, creating the track record here for the account. So the account started with 1,000 euro. Today we are at 1,170, and so it's close. It's close to 20% profit up to now, or to be more precise, it's 17% because of the loser trade of today. But anyhow, so we started 1,000 in 10th of April this year. And you see the sequence of trades here. And let me move down here that we can see the chart of that account, that you get a feeling of the equity of this account. And here you see more or less the opposite of the previous strategy. The first half here is more or less flat, and the second half shows an increasing equity. Perfect. You see already what's finally good? Combining strategies. Because the other one, the DAX daily seasonal, was exactly the opposite. Increase at the beginning, flat afterwards. Perfectly fit of those two equities combined to one, and you have a strategy in total which goes north and now more steady. What do we have here? We have a drawdown in total of close to 11%, but our profitability up to now is close to 20%. So risk-reward ratio here is already about 2 to 1, which is excellent for any strategy. And you see how it works. There are times, more or less, with no change in the account. Then we have that drawdown here. And there was a 10% drawdown, which is shown here as the maximum drawdown. And from there, we have a steady increase of the equity. Perfect. You see another thing here about talking about trading strategies and looking for real account results. Ask yourself, you would have started that kind of strategy, and after 55 trades you have been here. Maybe you would say, I stop the strategy, doesn't work, I go to the next one. It's good that I have not followed that kind of decision. Now I have that increase. That's exactly what I intend to do here. So once again, that strategy is already more or less at what I expect after 1 year, but it's already now here. Hopefully I don't have the next big drawdown here, but it doesn't look like that. So that's a real account, a real trading track record. And I repeat myself, ask any webinar, within webinars, seminars, wherever you are, show me your live track records, and people who talk about trading should be able to share those results with you. That is something I can only recommend, even if I did it now already twice. So that was the second strategy about open range breakout. Works very good. And let me now summarize what you have learned and what are the actions if you apply those strategies for your own trading activities. So first of all, I repeat, without edge, no trade. So when it comes to trading, ask yourself, if I open that specific next trade, do I have something which proves me that this has an edge? Because on the long run, we want to be on the winner side. Of course, any strategy is not creating only winners in an endless sequence of trades. Definitely no. But the sum of our winners should exceed the sum of our losers. And only if we trade what we know, and if we know that we have such a statistical edge for our trading setup, then everything is all right. And that's exactly how it should be. You have learned one trading setup, which is called the DAX Daily Seasonal, and that is definitely doing one trade per day, and that each day, without exception. And all actions needed is looking at 8 o'clock in the morning to the open of the FDAX. And if we are above the previous day 40 EMA, then we are in a bull market. And our next step is what day of the week we have, and that decides whether we go long or short. The other trading strategy is an open range breakout. My example here was in Euro Japanese Yen, but there are lots of other examples as well. And in this case, we typically do one trade per day, but not necessarily every day, because sometimes we don't break out of our range. Maybe we break out, but on the wrong direction, not in the one we have placed our order. So it's not every day a trade, but nearly every day there is a trade. And the actions needed are at 10 a.m. for that kind of strategy to place the order. And the next action, oops, there's an O, and no, it's 10 p.m. once again, that we close a trade if that trade has not reached neither stop loss nor take profit. And that's all we do. So those are two quite well good trading strategies. They can be easily adapted and they can be traded manually as well, although I trade them with an expert advisor, so I don't have to do anything for that. But for those kind of things here, they can be done manually as well. If you are interested in more about profitable trading setups, I just want to recommend the JFD Research and Education webpage, because there you can find lots of webinars all over the months. Nearly every day there's something which might be of interest for you. Or you can look to the YouTube channel of JFD, not only for going live, for live streams like here today, but you can see all the recordings of the previous webinars. So there is a lot of content which might help you for your own trading. Yeah, that's from my side. If you have any interest here in Excel sheets of that daily, of that DAX seasonals, just send me an email. Or if you want to have the slides of today, same thing, just send me an email to s.friedrichowski@jfdbrokers.com, and I will make sure that you get those material on short notice. Or if you have any other question, send me an email as well. Good. That's for me. That's for now. I hope you enjoyed the webinar, and see you at any time in any other webinar. Bye-bye. Have a good day.